I don't want you to worry too much about that. If you get it clear in your mind, the case of two variables and what it means if two variables are co-integrated, I think that's sufficient for your understanding of it. Okay. In econometrics, there's vector autoregressions that are often run. We might have touched on them briefly in the Armin modeling, but basically, you know, if you had 5 different variables, you end up with a matrix. You end up with 5 different equations, and you have, you know, this is variable 1, y1. This is variable 2, y2, y3, y4, and y5 of t. And they are equal to, each of them is equal to an equation that includes the other ones and lagged versions of the other ones, okay? And lagged versions of itself. And that's a vector autoregression. And you can run similar tests in terms of co-integration, where you're dealing with a matrix. So here you might have y1 of t minus 1. And y of 2, y of 3, y of 4. And an intercept. And basically this set of equations is a matrix, and this is a vector. And people would refer to this, like in this case, he's referring to a vector, okay, k by 1 vector. And that's what that notation means. You know, he's calling this z of t, for example. And in vector autoregression terms, when you've got systems of a number of variables, each of them can depend on the other variables and on lagged versions of them. And you end up with quite complex systems, okay? And the same thing applies with co-integration. But for the purposes of this course and learning, you should only really worry about the case where there's 2 variables, okay? And testing whether those are co-integrated. Okay. So, in this case, he's saying there may be up to 4 co-integrating relationships. So if we had 5 different variables, or would be 4, and there could be up to 4 co-integrating relationships there. Okay, so in this slide, it's giving some examples of co-integrating relationships in finance. So I tried to give the intuition where there's some relationship between the 2 variables, and there's something that binds them to each other, okay, in a long run way. So in the same way that somebody walking their dog, you know, from moment to moment, they don't have to be beside each other, but over time, they always come back to the same spot, the 2 of them. There's a binding relationship between them. And there's a very strong binding relationship between spot and future prices in finance. You know, because you could just buy the spot and provide the future, sell the future to somebody. Relative prices and exchange rates. So let's say the exchange rate changed in a country, and you know, the price of buying some commodity in that country is quoted locally in the local price. You know, if you look at an ounce of gold, for example, and if you buy it at a certain price in sterling, you know, if you multiply that by the exchange rate to the US, it should be the same. Okay, the price of the gold should be the same, irrespective of the exchange rate. But you'll find that that isn't immediate, because the 2 markets aren't necessarily interlinked. So, if the price of gold in dollars changes, people who are selling gold, you know, in jewelers in London or whatever, the prices of their merchandise won't track that immediately. You know, there's going to be a sort of a lag relationship there. Eventually, their prices will track the other prices. Okay, and there's something that basically ties them together. In this case, somebody could travel to the US, buy a lot of gold, and bring it back to the UK. And they could, if the prices weren't consistent with each other, they could make money doing that. And people would do that, and the price would drop or raise to get rid of that opportunity. But it wouldn't be instantaneous necessarily. And that could be something that causes a co-integrating relationship. And equity prices and dividends are the same. You know, eventually companies have to pay out dividends, and the value of the share of in the company, it should depend upon what the income is from holding that share at some point. I mean, people invest in growth companies that don't pay dividends, but at some point in the future, they're expecting them to start paying dividends. There has to be some way to get money out from the company. Okay, so what it's saying here is that there's market forces from no arbitrage conditions. So that means people are trading. And if there's a mismatch, if something doesn't cost what it should, or there's a way of making money by buying something in another country and importing it, people will do that. And that process will bring the prices back in line with each other. And that's basically similar to a pairs trader. Even the act of a pairs trader doing this trade will bring the prices back together. Because they're selling the one that's overpriced and they're buying the one that's underpriced. And that pressure means there's more demand on this one, which should make the price go up. And there's less demand on this one, which should make the price go down. Okay, so even people doing this trade will force the trade to disappear. It will bring the spread back to zero. Okay, so that will be a statistical arbitrage. So when it talks about no arbitrage conditions, that could be one of the market forces that causes these relationships to hold. Okay, so if you just take the first difference, as I mentioned before, and deal with returns only, the issue with that when you're examining two sets of series like this is that on average this relationship doesn't exist. So on average the difference is zero, okay, and the relationship doesn't show up at all. You know, so if you were searching for pairs trading opportunities, for example, and you just got returns, you wouldn't see this kind of relationship in the returns. They just wouldn't exist. They wouldn't be there. Okay. So there's a long-run relationship between the two that you're not seeing when you look at the log returns. Okay. So when they talk about long run here, they're basically defining the long run such that the effect disappears. Okay. Such that the difference between them is zero. Okay, so does everybody understand that? Like, over time, we're saying that these things, in the same way that, you know, if someone brings their dog out, the distance between the man and the dog, it widens and then it gets narrower again, and it's at zero. If you just ran a regression on the difference between the man and the difference in the dog's position, this wouldn't show up, this relationship here. So what you would see is that there will be no relationship between the two of them. The dog would appear to be moving randomly left or right, or 100 meters this way or 100 meters that way, on average. And the man would be doing something similar. And you know, there might be a small correlation between the two, but you wouldn't necessarily capture the relationship between the two of them. Okay. So one way to test for co-integrating is to look at the difference terms, as we mentioned before, in each individual variable, and then this subtracted series between the two of them. Okay, where you subtract one from the other and you check the beta term on that. And this is basically an error correction term. Okay, so you're basically saying that if this gets large, if the error gets large, the error correction term kicks in, and it subtracts from the error term to bring it back to zero. So it's like an error correction term in the equation. Okay? And it depends on the difference between the two of them. So once you work out what the co-integrating relationship is, and you get this difference term, you can add it in as an error correction term to a standard regression. And that picks up on the fact that there's a relationship. So you've got the return of y of t, the return of x of t, which is a standard regression, like we've been running. And then you've got beta times this error correction term, which is enforcing this relationship here, okay, which wouldn't show up in a normal linear regression. So if on a particular day you had a change in this series, it would cause a change in the other series as well. Okay? And then there's another term which is dependent on the difference between the two series. And the higher the difference is between the two series, the bigger this correction term is. And it comes in to correct for that difference. Okay. So you can run OLS on this. You can just set this up and run a regression on it. Okay, so in general, and we're going to do this in the lab, you can test for co-integration by just running a regression, okay, and then you take the residuals of the regression and you test them, okay, and you test them for a unit root. So you want to test, are they non-stationary or stationary? If they're stationary, it means that there's a co-integrated relationship there. Okay? So remember, the first thing we do is we test, are both of the variables, if you have two variables, are both of them non-stationary? They have to be non-stationary. Then we run a regression on one on the other, and that's giving us this basically scaling equation. It's basically the beta will give you what scaling the index is of the other, okay? Or it's a linear combination of the two. And what we're testing for is that is stationary, okay? So if we run that regression and we take the residuals, they should be stationary. Okay. If you just had two non-stationary variables and you ran this regression on them and they weren't co-integrated, and you tested the residuals would also be non-stationary. Okay? The only way they can become stationary is if the two variables are co-integrated. Okay. When you run that ADF test on the residuals, the critical values change. Okay, so we're not running the residuals anymore on an actual model. So in order to deal with that, there's a new interpretation, that a new set of statistical inference and tables that have to be used. Okay, and Engel and Granger came up with a set of critical values for the t-stat of that test, and that's why it's called the Engel-Granger test. But it's very simple to run. You run the regression, you keep the residuals, and then you just test the residuals, and you see do they have a unit root or not. Okay. If they don't, then they're stationary. The original variables were non-stationary, and the only way we could have got stationary residuals from a linear combination of those was if they were co-integrated. Okay, so this covers basically the two steps that you do in that, and we're going to cover it in the lab as well. And so the first thing, you check that all the variables are I of 1, then you estimate the regression using OLS, you save the residuals of the regression, and then you test those residuals to make sure that they're I of 0. Okay, so I mentioned before where you have more than a couple of variables. So the Engel and Granger two-step method, that's fine when you've got two variables. But if you've got a system of equations, you need to use something else. Okay, so What I'm going to focus on in the labs is the two variable case and the Engel and Granger one, and that's what you're going to run. So I should point out that all of this is covered in the textbook in chapter 8. Okay, so so what you need to know basically so the modeling long-run relationships in finance. Okay. So what you need to be able to do is to run the Engel-Granger test and to interpret the output from it, and then just to be able to comment on the difference between it and why you might use this Johansson technique instead. Okay, so this Johansson technique it uses eigenvalues and eigenvectors and the rank of a matrix. So it's I'm not going to get into the technical details of the test, okay, because it's quite a complicated test. But what I want you to understand is that when you've got more than two variables, you need to use another type of test than the Engel-Granger one, and it's this Johansson one. So if you look at last year's exam, there's a question on that. But this year I'm covering the single or the two variable case, okay, and the Engel-Granger test in the lab. Okay, so I'm gonna skim over the Johansson test here. This is how you run it in eViews. So one of the things you do initially in eViews with the Johansson test is that you need to specify the actual model that you're using. So there's a number of inputs to it, like as to whether or not there's a data trend or an intercept, and this is doing basically what we did in the labs before. You're going to pick the model with the best information criteria. Okay, so you can see the Schwartz one here and the Akaike one here, and then you go back and you rerun that model. So first of all, when you go to run this test, a window pops up in eViews, and you can automatically let it evaluate all models, and then you pick the best one and you rerun that one. Okay, so the main thing here is how do you interpret whether or not something is co-integrated using this test if you're doing it yourself. And what this is basically saying is that you've got a null hypothesis that there's no co-integrating relationship, the none one here, okay? And we can reject that at the 5% level, okay? Because the p-value is 0.03 on that. Then the next test is that there's at most one co-integrating relationship, and we can't reject that. Okay, so if you can reject the fact that there's none, and you can't reject the fact that there's at most one, that means there's one. Okay, so there's one co-integrating relationship or one co-integrating equation, and I mean it even states it here in eViews. Trace test indicates one co-integrating equation at the 0.05 level. Okay. So that's a positive test for co-integration between the two indices. And we're going to test using the other method in the lab, the Engel-Granger method. Okay, so does anyone have any questions on that? We're going to cover the co-integration test in the lab later. Okay, so it's not part of your coursework, but it is examinable. So it could be on the exam. And the type of things you'd be asked in the exam are, how would you run the test and how would you interpret the output? And maybe if there's two different types of tests, to say why would you need a second type? What's the difference between the two? And I mentioned already, if you've got more than two variables, that's why you would use the Johansson test. And then last year I asked people how they would pick the correct model. So you pick it based on information criteria here. You let eViews pick the best model, and it gives you all of these different models here. And you try and find the one with the best information criteria. Then you input that, and you run the test on that one. And then you interpret the output here. Okay, it tells you you know, there's one co-integrated equation at the 0.05 level, but you can see that you can reject that there's none, but you can't reject that there's at most one. So that means there's one. Okay. So today in the lab we're gonna finish off the last bit that you need for your coursework, which is the gauge forecasting and how you do gauge forecasting in EVUs. And I'm going to cover that in the lab. It's quite straightforward. There's some little equations you're going to need to copy to work out the actual realized volatility from your series. You all have a different time series. For the first 3 years and 11 months, you're going to take the first 3 years and 11 months and you're going to try and find the best gauge model, and then you're going to use that to forecast the last month, okay, and to forecast the volatility of the last month. Then you're going to calculate the actual volatility of the last month, what it actually was. So your model has given you a forecast, and you're going to compare that forecast against the actual one to see how good you were. Okay. So if you were selling options to somebody, the higher you thought the volatility was going to be over the next month, the higher the option price should be that you would quote. Okay. So if you sell the option very cheaply and volatility is high, they could make a lot of money. You'd have to pay them a lot of money. You'd lose money. If you make the price too high, nobody will buy the option off you because they'll buy it off somebody else because your price is wrong. So having an accurate volatility forecast is very important, especially in options markets. So that's what we're going to do today, is to look at how you would forecast volatility for 1 month. Okay, so if you were going to sell somebody an option that expired next month on the S&P 500, and you were going to use the Black-Scholes equation to calculate the price of the option, one of the main inputs would be a volatility forecast. And what we're going to do today is to figure out what your volatility forecast is, what you might plug into that formula, and once you did that, you would get what the fair price of the option will be. Okay, so does anybody have any questions? Any questions on the lab, your coursework, anything? No? Okay, so we have a lab today at 4. And as I said, we're going to do gauge forecasting, and we're going to run the angle Granger co-integrated test. So if you have any questions on your assignment, you can ask them during the lab as well. Okay, so I'll finish there on the lectures for today. If anybody has any questions, I'll be here for a little while.